I want to bring Abigail Doolittle into this conversation, as we do every day at this hour for our Options Insight segment. And Abigail, I was taking a look at the markets today and really for the week as a whole, and I took a look at the VIX. It's down a few ticks today, back down around 25. What gives? Yeah,
it's pretty interesting, Romaine, because usually people think about the VIX going higher when stocks are lower, and certainly on the day we're off of the lows, but on the week, down 4 days in a row, the worst week, I think, since the middle of September. I'm going to take a stab at this, and I think it has to do with the fact that the VIX measures uncertainty, volatility, not fear. And so this may suggest that now that we have some more clarity from the Fed, we're looking at smaller moves ahead. But let's bring in Kevin Kelly, CEO of Kelly ETFs. Kevin, how did I do there?
You absolutely nailed it, because one of the biggest points of uncertainty for the VIX was what's going to happen with the Fed, especially with guidance. And what we've seen is that removed a critical data point that is incorporated into VIX, because VIX is a 30-day indicator. So the Fed's not going to talk about or do anything with rates for at least the next 30 days. So you can see volatility come lower, and we also have earnings out of the way. The only real data point that VIX is going to reflect is this Friday's jobs number. And so, that really shouldn't move the Fed one way or another, because we got a lot of indications that from the press conference yesterday, and it's only one single data point. So you've hit the nail on the head. And I would just like to point out that it is an uncertainty index, not a fear index. And we've seen that because we're below the average on VIX today than we have been all year. So the VIX has averaged 26.25 all year, and we're below that. And that's telling in and of itself.
Well, Kevin, you are the person who certainly has taught me about that the VIX is about uncertainty and not fear. Another time I would love to talk about the panic index, or that skew index, and whether that really is panic. But, you're speaking about rates, this movement in rates that we've had this year, the 10-year yield backing up more than 2.5%, really creating this repricing of risk. And that's especially true for the real estate segment. But, tie it all in, volatility, the VIX, real estate rates.
Yeah. So one of the interesting things that you can see from yesterday's press conference is that they're going to hold rates at that level for a certain amount of time. The Fed, the market should not expect the Fed to pivot and reduce rates should anything happen. And so that's going, like, higher rates for longer is going to impact the third largest asset class in the United States, and that's real estate. And we're seeing that play out in the deepest, most liquid real estate ETF that's traded for capital market purposes, and that's called the IYR. It's the iShares US REIT. And we're seeing 10 times the amount of puts being traded versus calls, because there's so much rate uncertainty now in real estate that it's certainly going to impact discounted cash flow, renewal rates for real estate. And so you're seeing that being hit really hard in the options market on the put side. Tons of puts being traded, 10 times the amount for real estate.
Yeah, so it seems it suggests that many investors think that we'll see more downside for real estate. When I take a look at this XHB, which has a lot of different things in there, it's not just the home builders. I think it's down 40 or 50% this year. So are you telling me that if we take the IYR to the XHB, that there's more declines ahead?
Yeah, so the options market is signaling that worry, that uncertainty now around the real estate market. And one of the reasons why is if you go back to real estate market when it blew up in 08 and 09, we had the high on the VIX for the year at over 80. We haven't even eclipsed 36 really this year. And that from January 1, 2008, all the way to the bottom of the market in 2009 in March and April, we averaged 36. So we're not even close to this uncertainty. And so that is a real estate dislocation that happened. If we're going to have that again, we're going to need to see VIX really, really come up.
Well, I won't hold you to it, but you heard VIX 80 from Kevin Kelly first here on Options Insight. Kevin Kelly, CEO of Kelly ETFs. Thanks for joining us today, as always, for Options Insight. And from New York, this is Bloomberg.